Welcome to the Evans Legacy Financial Podcast, where real people have real conversations about money, mindset, and making moves. I'm your host, Jake Evans, and this show isn't about fluff or hype. It's about educating our community, sharing stories, and giving you the tools to make better decisions in business and in life. Let's dive in. I'm here with Javier Veliz. He's a businessman who's been in the insurance industry for 30 plus years, and he's got so much wealth under his belt. I had to bring him in because I think that there are some things that we, as the layman or the person, just out there, needs to know about insurance, life insurance, long-term care, and wealth protection. You agree with me?
Definitely, I agree with you. A lot of people just they think of life insurance as death insurance, and they don't realize that there's a lot to it. And what I've found is that life insurance is different for each individual with their individual family and their individually family situation. I can do work with people in the same family, brothers, sisters, parents, and each one of them has a different need and a different situation. Not one policy fits every person.
Right. And we're gonna dive into all of those aspects today. Sure. And so the first thing I want to do is this episode, we're going to do kind of a mini series here. We're going to do 3 different episodes. So this first one, we're going to talk about life insurance and its real impact, okay? Mm-hmm. So I want to welcome everybody to the show. I want to thank you, Javier, for taking time out of your day to do this with me. And this is going to be a comprehensive exploration of life insurance, long-term care, and wealth protection, the whole show, the whole 3 episodes, okay? So I want to correct me if I'm wrong. So I want to share kind of a little anecdote about life insurance. So Mark, you got Mark and Lisa, okay? And Mark, small family, they got a couple of kids, and they're going about life, and Mark has an accident, he passes away. But fortunately enough for Mark, he has like a $500,000 life insurance policy, okay? So now what are we looking at? We're looking at Lisa and the kids. They're taken care of. Maybe their house gets paid off. She gets to pay the bills, gets to pay the burial expenses or whatever it is, the afterlife expenses or whatever it may be, okay? Now, imagine the flip side of that if David didn't have a policy, right? Right. And Lisa is struggling and she's falling apart and it's devastating to her. So that's kind of what we're going to talk about today. Sure. Is what is life insurance really about, okay? So first question I have for you, Javier, is what are some of the biggest misconceptions you've encountered about life insurance? We're going to debunk common myths like life insurance is just for after death. It's too expensive for most people. Explain the core difference between. Okay, so let's go into that part first. Let's go into some of the biggest misconceptions you've experienced or encountered about life insurance.
Well, I think that in every situation, people always want the best life insurance policy. And
what constitutes the best life insurance policy?
Well, in my experience, Jake, the best policy is the one that's in force on the day that you die. That's Boom. The best life insurance policy.
Exactly.
and that doesn't mean that it was the most expensive or it was the most had the most bells and whistles. The best policy is the one that you have coverage on when you die. And we know that we're all going to die. We just don't know when. But let me tell you what, your beneficiaries will know when you die and they get the check for the death claim. They'll know that you took care of them. And,
right.
So I'm going to give you the tale of 2 stories. So one story is that I had a guy when I was first starting in the business where I didn't have a lot of strength to sell. His name was Steve P. He was my next door neighbor. And I was moonlighting. I was selling life insurance after my 8-hour day in order to make enough money to then make a transition to become a full-time life insurance agent. And Steve was one of the first people that I talked to. And Steve wanted the best policy. He wanted a whole life contract. He wanted to spend about $300 a month for a policy but he couldn't afford it right at that moment. In 6 months, he was going to be finished paying off a truck payment, and he said, "When I'm done paying this truck payment, then I want to buy this whole life policy."
So I'm gonna interject something here. So that makes, see, to me, that makes perfect sense. You're already coming out of pocket with this money, and you're already spending it, so you don't really have it. So when it's transferred into something and keep making a payment on something, if you can afford to do it, correct? It's what I'm hearing, right?
Yeah, that's what he wanted to do, but he was 6 months out.
Okay.
And so I just accepted it. I just said, okay, yeah, we'll do that 6 months from now. I didn't have the strength to sell him a $12 a month term life insurance policy. And 3 days after my appointment with him, I came home from moonlighting, and there were all these cars outside the neighborhood. And
I'm not seeing a happy ending here.
No, I walked up and I found out that he had been in a car accident. Someone had been driving the wrong way. Now, this is 30 years ago, because I've been in the business. This is I'm working on my 31st year. So this was right before I became a full-time life insurance agent. And what happened was he was in the car accident, and he lived through it, but he was very strong in his faith as a Jehovah's Witness and would not take a blood transfusion, and then he died.
Okay.
And he had bought his home right next to my home, and his wife was she was so devastated. She was like in total shock that her parents had to come from South Carolina to Fresno and stay with her because she needed medical attention. It took them about 6 months to sell the house, but they sold the house at a fire sale. So they sold it for about $15,000 to $20,000 less than what they purchased it for, just so they could get out from under it. They had mortgage protection that paid off the loan, but in order to sell the house, they had to do a quick sale. They got out of it as quickly as they possibly could, and then they moved to South Carolina, and I never heard from them again.
And that's unfortunate that you, I mean, it's not your fault, but it's unfortunate that couldn't have been prevented.
Well, it could have been prevented had I been a stronger life insurance agent, but then that's when my mission started.
Okay. Because
I never, ever, ever wanted to feel that again. So that's when they used to talk about this when I started in the business, that I had to be in the religion of life insurance. And what that meant was that everybody that I talked to needs to have life insurance. Everyone that I talk to. If you don't have it, you need to get it. And I don't care if you have to spend $12 a month for a very inexpensive term life insurance, which I consider a Band-Aid insurance plan. It's a Band-Aid to take care of your family in the case that someone passes away.
So I'm gonna go into that right now.
Sure.
I'm gonna segue into what you just said, term life. Okay, so we got term life, whole life, we've got universal life. I'm sure there's more. There's long-term care and all that. But right now I want to talk about what are the differences between term, whole, and universal life policies. Give me a rundown on those three.
Sure. So term life insurance is going to be the most inexpensive plan that you can buy. You could buy it for as little as every year it renews at a higher price. That's going to be the cheapest term life insurance policies that are available. They're hardly sold at all. Usually people want a fixed rate, so you can buy a 10-year term, a 15-year term, 20-year term, 25-year, 30, 35-year max. And what that means is that you can lock up a premium that will never change for as long as the period of years that you purchase. The problem with that is that you're renting the insurance, which means that you don't have any ownership in it. The premium will never change, but as you age, once that policy comes to the end, then you will let it go because the premium will be prohibitive. You won't be able to pay the premium in the later years. So when people are in their mid 60s, early 70s, and they want to get a quote for term life insurance, they usually feel, wow, that is so expensive. It's just because the companies are very smart. They have actuaries. The actuaries, these people, they know, they have been trained. They actually learned in college the statistics of when someone is going to pass away based upon different health conditions, factors, height and weight, whether they smoke or not, and they determine the price based upon those factors. So the insurance companies know that probably you're going to live the length of the term, and at the end of the term, they're going to get all their money. They're not going to pay out a death claim, and they're going to have been using your money to reinvest to make money for themselves. And when they don't pay out the death claim because you live past the term, now you're in a position where you either need to buy a lesser face amount or a smaller term amount, length of time, and so the insurance companies have that all kind of figured out, and that's why the insurance companies are the most profitable businesses in the United States in financial services, because they know this. So, but see, term still though gives a person a level of, I guess you could say, a level of security and safety.
Right.
Yeah, and so I figure out a mix. So I tell people, if you're going to buy a 20-year term for let's say $1 million of insurance coverage, I want them to make sure that they have a permanent policy also in place, so that way when the term ends, they still have another plan.
So that comes into whole life, right?
Yes.
That segues into our whole life. So explain that to me.
Well, I'm gonna redesignate that as permanent insurance.
Okay.
Under permanent insurance, you have different types of insurance. So you have, as you mentioned, whole life insurance, and then you have what is called universal life. Then there's indexed universal life, also known as IUL, and then there are variable universal life contracts. So the most conservative of all of those is the first one, the whole life. The whole life policies have been around since the life insurance companies started, 150 to 180 years ago. Whole life insurance policies were the policies that your grandparents and your great-grandparents used to buy. They would buy small policies, and they were expensive policies, but because they're whole life, what that means is that the company will pay dividends, and everything is guaranteed in the policy. They guarantee your premium will never change. They guarantee you a certain amount of cash value after a certain amount of years, and they guarantee you that your death benefit will never go down. As long as you pay the premiums, you have all of those guarantees, and then in addition to that, you have the dividends. The dividends aren't guaranteed, but it usually takes about 20 years for those dividends, which are basically the profits that the insurance company is giving back to the insurance holder. And then those dividends, at about 20 to 25 years of paying them, they're usually enough to pay the premiums going forward, where a client can stop making their monthly premium payments. So
Okay.
whole life is the most conservative of all life insurance policies, and we still have some companies that still offer whole life, but a lot of the insurance companies went the route of universal life. So universal life it doesn't have the guarantees, and inside of it, internally, the life insurance premiums increase every year that you get older. The cash accumulation that's growing is hopefully growing faster than the amount of the cost of insurance that's growing every year that you get older. But eventually, if you're just paying a minimum funded universal life plan, eventually those plans, when you hit your 70s, mid-70s, they tend to run into problems because the cost of insurance is much greater, and sometimes clients will get a bill saying you need to increase your premium or your policy is going to lapse. And with all the cash accumulation going towards paying those increase in premiums. So people get swayed by buying the universal life because it's cheaper than a whole life, but they have a trap, and that problem occurs later on in life as the internal charges increase. So what's happened since I have been in this business at about 23 years ago, I ended up starting with what is called a index universal life, the IUL. And the IUL basically mimics the marketplace, such as the S&P 500 and the NASDAQ. And there's different what we call sub-accounts. And those sub-accounts give you the opportunity to earn anywhere between 6 to 10% interest over time. And in my experience, over the last 23 years, the clients that I put into these policies 23 years ago, they over these last 23 years have averaged about 6% over time. And so it's been strong where the policies look like they're going to move forward into their old age with no problem.
Okay. Well, that's and that was, you kind of segued into everything that I wanted to talk about there. So the follow-up question on the policy types,
sure,
is how do you help clients determine which type suits them best?
Sure. So when I meet with clients, I want to know what their financial objectives are, when they plan to retire. I want to know if they're putting money away in other vehicles, and so how much debt do they have, what is the length of their mortgages. I take all those things into consideration. We figure out how much death benefit a person should have. Usually, the insurance companies allow you to buy 10 to 12 times your gross annual income. So once we figure out what that amount is, then I let the client determine what they feel comfortable with, and then based upon what they can afford, what we can do is set up a portion of the death benefit in term insurance, and if they can afford it, also a portion of their death benefit in what I favor, the IUL, the Index Universal Life Contract. So that once the term is expired, they still have the Index Universal Life Contract in force that takes them to their old age.
Okay, well that's all. I love that, and we've talked about that, and I like that idea. And when I go a little bit beyond the basics here, many people, I don't think many people realize that life insurance can actually support you when you're alive. What I want to talk about is living benefits such as critical illness, accumulation, and policy loans. Talk to me about that stuff.
Sure. So with both with term insurance and with the IUL, these policies have living benefits, and if you should become chronically ill and you've been told that you have a short amount of time to live, the insurance company will advance you your death benefit while you're still alive, and it's income tax free. So that's a nice benefit.
So wait a minute, you're telling me that my insurance policy that's supposed to pay me when I'm gone,
Mm-hmm.
if I become unable to do what I'm understanding is maybe 2 or 3 daily functions, it's gonna give me a paycheck every year?
That's a different.
Okay.
So chronic illness has to do with if you've been deemed that you're chronically ill, meaning you are going to pass away. Let's say you're stage 3 cancer or stage 4 cancer,
Mm-hmm.
and they've given you a timeline. They say that you're probably not going to make it more than 6 months or 9 months. At that point, you can take a portion of your death benefit in order to maybe get some additional medical treatment or whatnot. So that's the chronic illness part. Now, what you're talking about is there's another part to this where if you become incapacitated either through dementia or Alzheimer's, or you have needs for help with the assistance of being able to get up out of your bed, walk over to the restroom, use the restroom, bathe yourself, feed yourself, dress yourself, maintain continence. Those are the activities of daily living. And some life insurance policies will allow you to access your death benefit in the form of a monthly check while you're still alive. Sometimes it'll be about maybe 4% of whatever your death benefit is, or 2% of your death benefit. And the money is not paid to a facility. It is paid directly to you, and you can pay anybody who you want in order to take care of you, even if it's in your home.
Okay. Now we talked about, I mentioned accumulation, policies as a financial asset. Tell me
Sure.
about that.
And the IULs, if they're properly structured, you can also use those in a way to where you can grow a risk-free and a tax-free, I wouldn't call it retirement plan, but a supplement to your retirement plans. And so, for instance, if you were able to put away, let's say, $200,000 in your life insurance policy, and by the time you turned 64, let's say that there was $400,000 of cash value in your policy, you could actually start to take out a policy loan. The first thing that comes is the first $200,000. That's your cost basis. That would come out of your policy first, and then eventually the additional gains would come out in the form of a policy loan, and you could take out, let's say, $40,000 a year from age 65 to age 80, and not pay any taxes on any of that, as long as the policy is kept in force, as long as you keep the policy in force. And then when you die, the loan gets deducted from your death benefit, and your family still gets the income tax-free life insurance plan.
Wow. Okay. That's such great news. I mean, it's more than just a check after you die. Then, I mean, life insurance in a whole can be more than just a check after you die.
Sure. And one other thing too that we didn't mention, but also, if let's say you had a heart attack, mm-hmm. or let's say that you injured yourself, there's different things that could give you some money during the time that you are down. So, like, for instance, if you had a heart attack and you're they might give you $50,000 to bridge the gap. So you have that ability. These policies are a lot more. There's a lot more. I like to think of them as a Swiss Army knife. Mm-hmm. There's so many different ways that you can use it, so.
Okay, great. So, what are the most important key factors, key considerations when selecting a policy?
Okay, well, I think that you should have companies that have good financial strength, which we all, under our platform, we deal with nothing but A-rated companies. So, financial strength. I particularly favor certain companies because in my time in the business, I've delivered 38 death claims since that night that Steve P. I didn't write in the policy.
So you've done more than one every single year. Gosh, that's got to be
Correct.
Rewarding. I mean, there's some reward in that, right?
There is, and the thing that I tell people is that a life insurance agent really doesn't start work until someone dies, because there's a whole process on helping somebody. You don't want to deal with the insurance company on your own. You want the insurance agent to advocate for you. So I know all the ins and outs of how we get the check, how do I get the check delivered to the client, how I deal with the funeral home and the cemetery. So I start all that process of helping the clients, because the last thing they want to be thinking about is how am I going to get the money. Mm-hmm. So I take that ownership and become an active part of that. In fact, I am going to a funeral tomorrow at 11:30 a.m. for a client that has been with me for 28 years. And so It happens. It's just a fact of life, and so I just try to make sure that I make it easy for the clientele, and usually I tell people, hey, whenever I'm in a competition situation, I just tell the client, hey, ask the person that I'm competing with how many death claims they've processed, because I have the experience and I know what it takes.
I think that delivering that death claim usually means that client's been with you for a very long time and they trust you and you know what you're doing.
Yeah, that's right.
Okay.
And I have the insurance companies. They haven't changed much. The insurance companies always want. They like for the agent to deliver the check, so the check gets mailed to me, and then I deliver it to the client, and it's just a personal touch for the insurance company as well as for myself.
Okay, so I kind of missed something. I want to go back, and I want to hear about maybe a real life example where we're going to talk about living benefit again, but where a living benefit actually made a difference.
Sure. So under the current policies right now that are being written over about the last 5 years, 6 years with living benefits, I haven't had anybody need to use those benefits yet. But under the living benefits of a policy that I wrote I'd say it was about 28 years ago, it was with I don't mind mentioning the name, a company called John Hancock. And John Hancock, with this particular policy, the client had the waiver of a premium benefit. And so, as it turns out, during the time that I sold him the policy, he ended up with a railroad crossing accident. And when that happened, he ended up becoming paralyzed from his waist down. And I had met him. When I met him, he was walking. And I wrote the application. I took the premium deposit. And during the time of the underwriting of the policy, that is when the accident occurred. After his policy was approved, I went to deliver the policy and could not find him. And then just by accident, found out that he was in the hospital. And so I was able to get in touch with his wife. We were able to submit the paperwork for the waiver of premium. And what John Hancock did was they paid all of his premiums for the rest of his life. And so at last check, he had somewhere in the neighborhood of about $75,000 in cash accumulation in his life insurance policy, and he never made one payment on it.
And see, that right there you said it was a blessing. I mean, he had no idea that was coming.
That's right.
And it was there, and it must have been a huge relief.
Yeah.
It must have been a huge relief. Okay.
Sure.
Well, you know what? And I was going to ask you to share a compelling story about how life insurance impacted a family in crisis, but I think we opened with that. And I think that the lack of life insurance, how it can impact, I think that kind of answers both of how the lack of life insurance is more impactful than actually having life insurance.
And Jake, the thing is that I've had 38 death claims that have actually paid, but I've had about 6 people that have passed away that used to have life insurance, lapsed their policy, and then died. I've had the people that never met with me that I was calling on, and then one day they passed away, and I don't know whether they ever had life insurance or not. But then, so what I tell people is that we don't know when we're going to die. But life insurance is really love insurance. If you love somebody, then you should protect them.
So what I'm hearing here is life insurance isn't. If I'm thinking about life insurance, I'm not buying life insurance for me. I'm buying life insurance for those. And my business is Evans Legacy Financial. So what I'm buying life insurance for is my legacy. Is I'm setting up that legacy so when I'm gone, my family or my loved ones don't have to worry.
That's right.
That's exactly what it's all about.
That's right. But one other point, though. So I was taught, and I know this to be true, that life insurance is bought for two reasons. It's either bought out of that love for your family, or it's bought out of the tax advantage of dumping money inside of a life insurance contract and growing it risk-free and tax-free. So either way.
And you're building legacy there. You're taking care of everybody, even yourself at that point.
That's correct.
Yeah, exactly. So, well, that's awesome. So I want you to remember, people, Javier, man, thank you so much for coming in and doing this. And I have some questions for my audience. Do you have a policy in place? When's the last time you reviewed it? So, evanslegacyfinancial.com, there's a box at the bottom. You can email me any questions you have for Javier. I will get them right over to him. But, remember that it's never too late to get that policy in place. All right, so next time we're going to bring Javier back, and we're going to be talking about a topic that a lot of people avoid, but, can't afford to ignore, and that's long-term care. So Javier, again, thank you very much for being here today.
Sure, Jake. Thank you. It's my privilege.
Hey, it is, man. It is. It's amazing. And we'll see you next time. Thanks for tuning into the Evans Legacy Financial Podcast. If you got value from today's episode, share it with someone who needs to hear it. Don't forget to subscribe and follow us for more real conversations that move the needle in life and business. Until next time, keep building, keep growing, and never stop chasing what matters.